Okay, good afternoon. Can anyone confirm that you are listening to me clearly?
Yes, sir.
Okay, thank you. So I want you all to keep your microphone muted. So if you have questions, write it in the chat box. I will respond to questions later of the classes, later of the class for the constant of time. So residual income valuation. This is another flavor of valuation under the category of absolute valuation models, what have we seen earlier. So you can recall that we mentioned that residual income valuation becomes appropriate primarily in two cases. One particular case is when you see the company is not a dividend paying company. And another case is like that within the forecast horizon of the analyst, if the analyst observes that in every year my estimation for free cash flow to farm or equity is becoming negative, in that case, he or she can switch to alternative residual income valuation. So in this chapter, we'll be trying to see the construction of the residual income valuation, and I will try to apply it in some simple scenarios so that you can understand how can you apply it in realistic cases. So residual income, though it might be understood that it is a kind of new type of valuation, not very well known. But idea is that residual income is used under different terminologies, and it is very well known. If you need to think of how long it has been used in the analysis and valuation for economic transaction, the answer is that it has been used more than 200 years, but not in the name of residual income, but the name what you see in the screen, the alternative name, economic profit, probably you learned it earlier, abnormal earnings, or economic value added. I strongly believe that you in different courses came to learn these three different terminologies, which are equivalent to residual income. But we'll see a little bit differences in the calculation, but ideally speaking, these are similar, and this will give you the same kind of outcome. So I want you to remind that how the residual income is different from traditional accounting calculation of net income, that when we calculate the net income, it does not include the equity charge. It does not account for equity charge. So what we mean by equity charge? Equity charge we mean by cost of equity in dollar terms. So cost of equity in dollar terms, we mentioned it as a equity charge. We'll see it in more detail. So net income does not account for it, but the residual income accounts for it. That's why the residual income is used in the valuation. So if I want you to show the construction of the residual income from the broader perspective, you should think like this. We subtract the equity charge, which we calculate if I want you to show it, the equity value multiplied by the return on equity. We consider the return on equity as sorry, not return on equity. We take the cost of equity. So we multiply the beginning equity value by the cost of equity and calculate the cost of equity in dollar terms. And when we subtract it from the net income, we get the residual income. This is from the perspective of equity holders. But if you think from the entire firm, You probably are familiar with operating profit. We consider the net operating profit after subtracting all operating expenses and net operating profit after taxes. So you see, net operating profit after taxes, from here, we have not subtracted any cost of capital. We have not subtracted interest expenses from here. So interest expense is the compensation provided to the debt capital providers. So consider it here. Again, the equity charge, what have we considered, is the compensation to the equity holders for utilizing their equity. So in together, interest expense and the equity charge, both of them or both of these constitute what? The capital charge or the cost of the capital we are incurring in as a whole. So when you subtract the capital charge from the net operating profit after tax, we get the residual income. So this is the same thing. We look from two perspectives. So here, what I mentioned earlier, the cost of equity, sometimes the return on equity can be greater than the cost of equity. Sometimes return on equity is equal to the cost of equity. Sometimes return on equity, you will see that it is less than the cost of equity. So these three different scenarios have three different implications for this valuation. You need to remember this. So when I'm saying the cost of equity, you also need to consider that it is a kind of return on equity. Sorry, it is a kind of required return on equity. So any term you can think of, but if it happens that return on equity is equal to the cost of equity, then we can use anyone. I mean, if we have the return on equity, we can use the return on equity as a proxy for the cost of equity if the things are like this. But when the return on equity is greater than the cost of equity or return on equity is less than the cost of equity, we cannot use the return on equity as a proxy of the cost of equity. So let me show you a very simple calculation so that we can understand this straightforward equation. So think of this firm has a total asset value of 5 million. This firm is reporting operating profit after interest and taxes of 400,000. This firm has a debt to total capital ratio of 60%. This firm has a cost of debt 8%, cost of equity 12%, tax rate 40%. Remember what we want to do. We want to calculate the residual income from this scenario. First of all, out of this total asset, we see the debt to capital ratio is 60%. So can you consider that 3 million is debt and 2 million is equity? If the debt to capital ratio is 60%, very straightforward, right? Now, to calculate the residual income, we first need what? We first need the net income. Then we subtract the equity charge. So first of all, let's calculate the net income from this scenario. So we have the net income of, earnings before interest and taxes of 400,000. So if we subtract the interest expense and the tax expense, we should get the net income. So what is the interest expense from here? Is it possible to calculate? We have a debt value of 3 million, right? If we multiply this by 8%, we should get how much? We should get interest expense of 240,000. We have the EBIT of how much? 400,000. Now we have 160,000 pre-tax income, right? It is our pre-tax income. Now, if I apply the tax rate of 40%, the 40% tax rate will be how much? 64,000 on this. Now, how much is remaining? 96,000. Can you consider this 96,000 as our net income? Right? So we have the net income of how much? 96,000. Now, what should I subtract to get the residual income? I should subtract the equity charge. Can you recall how we calculated the equity charge earlier? Very simplistic scenario. We multiply the equity value by the cost of equity. What is my equity value? My equity value is 40% of the asset value. So what is the 40% of asset value? 2 million is the equity value. We are multiplying it by what? The cost of equity, 12%. Now, if I do this calculation, I should get what? I should get what? If I multiply this, I should get 240,000. 120,000 multiplied by 240,000. Now, if I subtract the 240,000, which is the equity charge from my net income, I should get the residual income of how much? I should get the residual income of how much? 144,000. Is this residual income negative or positive?
Negative.
This amount of residual income is negative. So what do we see? A firm which has net income positive, but it is reporting residual income negative. If the firm is residual income negative, or if the firm's residual income is negative, can we claim that the firm is not earning adequate earnings to compensate its equity holders?
Yes, sir, we can.
And we see that the firm's, this one, I mean, the net income is also being considered as the accounting profit. This is considered as net income is also considered what? Accounting profit or profit number. When we see the profit, we mean which one? The net income. But this profit, the residual income, can you recall which profit we mentioned? This 144,000. Which one? Economic profit, right? So a firm which is reporting accounting profit, but it is showing negative economic profit, right? And if it happens, what is the implications for the equity holders? Let me show you. When it is happening, can we confirm that this firm is not generating adequate return on equity, or alternatively, the firm's return on equity is less than the cost of equity? Can we confirm this if it happens when the residual income is negative? You see, the firm is reporting, I mean, the return on equity. Return on equity, how much? 96,000, right? How we calculate the return on equity? Can you recall? Net income divided by average shareholders' equity. Is it? Now, if I take the 96,000, which is the net income, and we divide this number by equity value. Equity value is how much? 2 million, right? 2 million. Can you tell me how much the return on equity is? You can write your responses in the chat box also. Is it 4.8%?
Yes, sir.
4.8%. So you see the return on equity is 4.8%. But what is the firm's cost of equity? 12%? Is it? If the firm's return on equity is less than the cost of equity, do you believe that firm is creating value for the equity holders or firm is destroying value for the equity holders? If the firm has return on equity less than the cost of equity, the firm is not able to create the value for the equity holders. The firm is destroying value of the equity holders. Okay. So keep these points in your mind and let's proceed. And let me show you the calculation in clear form. This is here. You should see the calculation of the net income, 96,000. And you should see the residual income. It's actually the negative, and that's 144,000. Now, as I mentioned that there are economic value added is also connected to the residual income, but there are a little bit differences with the definition of the economic value added and with the definition of the residual income. Okay. So what are the differences? The idea is that when you consider or when you calculate the economic value added, probably you learned it from your analysis of financial investment, these two terms, these two. When you calculate the economic value added, we consider that the expenses firm incur for research and development will be capitalized, and there will be amortization of the research and development expenses. However, when we calculate the residual income, we consider all R&D expenses should be expensed, not capitalized. So if entire R&D expenses are expensed, is there any place for amortization? So there is no place for amortization. Now, what is the implication for here if we follow the definition of economic value added? Think of that when we calculate the economic value added, this is capitalizing a significant expenditure, which is research and development. If it happens, the expense come down, other things remaining same. If research and development expenses is not expensed, it is capitalized, the expense comes down. If the expense comes down, net income becomes inflated. If the net income becomes inflated, there is a chance that residual income is also likely to be inflated. So what we don't do, we do not use the definition of the economic value added for estimating the residual income. For estimating the residual income, we should see that what has been done for research and development expense. If the research and development expense has been capitalized, we should expense it. We should not use this definition. Okay. And another idea to look at the residual income is to see, is to see later, but to see it later, you should feel comfortable with the market value added concept. Probably you learned it from your investment course, the market value added. So what we consider, we take the market value of the firm's capital, we take the market value of the equity, we take the market value of debt, because we see that the debt market value is sometimes absent. We consider the book value as a market value of debt. And we subtract what? We subtract the book value of our capital. And the difference we consider as a market value added. So to become a value generating firm, we should see that the firm has a positive economic value added and the firm has a positive market value added. So what are the uses of residual income? You already have seen that residual income is also being considered as a valuation metric. In addition to this, residual income is also being considered as a perspective to see that how the goodwill is being impaired over time. So over time, the goodwill value gets reduced. So you consider the residual income to see how the goodwill has been impaired. And we also likely to see the residual income to consider the corporate performance of the firm. If we see the firm is reporting a good or higher number of residual income, we consider that the firm has a very outstanding or a very good corporate performance internal. In addition to this, if a firm has a higher residual income, the firm's managements are likely to receive higher executive compensation. So let me dive more deeper of the residual income so that we can feel more comfortable with the calculation. So see the per share calculation of the residual income. So per share calculation. So what you want to see, you can think of earnings per share here. So you take the earnings per share in a specific period. We take the cost of equity, RE represents the cost of equity, and we multiply this by book value per share at the beginning of the period. Book value per share at the beginning of the period. Try to relate it with the definition with which you already have become familiar. Is the EPS representation of the net income? Right? And you see here, does this calculation reflects the equity charge? We are taking the equity value and multiplying by what? Multiplying it by cost of equity or required return on equity. So these are exactly same. We are just wanting to show you that the same thing can be written in terms of per share. Okay. So residual income per share is equal to the earnings per share. And it is subtracted for what? The cost of equity or required return on equity. I mean the equity charge, and it is equity charge is calculated by multiplying what? The cost of equity and the beginning value of equity per share. Okay. Now, look at here. If the firm's earnings is greater than the equity charge, the firm's residual income becomes positive. If the firm's earnings is less than this equity charge, the firm's residual income should be what? Negative. Okay. So it is very straightforward. So let's apply this understanding. So you see a firm reported earnings, dividend, book value, and required equity return for 3 periods: current period, the 1 year later, and 2 years later. So what should we calculate from here? We should calculate the residual income for each of the period. Okay. So to calculate the residual income, we should do some calculation before. First of all, we should calculate the net income. Do we have net income here? Can anyone tell me? From this data, do we have the net income? If it is, which one it is? Are you there?
Yes, sir.
So we have the net income, this number. Okay. Now we should calculate the equity charge primarily to get the residual income. So you probably can recall the definition of the equity charge. Equity charge is equal to beginning value of equity multiplied by the cost of equity. Now for this period, what is the beginning value of equity? Beginning value of equity is this 20. And if we multiply it by the cost of equity, how much we should get? 2. 20 multiplied by 10%, 2. Now I have the earnings of 2.5. Now if I subtract this equity charge 2, I should get the residual income. How much? In year 1. In year 1, I should
2.5.
get the residual income of how much? 0.5. Now, this is for period 2, you need to do some calculation. This is not as straight as the year 1. Let's see how. First of all, we need to calculate the book value here, because that is the book value, beginning book value for period 2. Okay. So how we calculate the book value? You probably are familiar with the, clean surplus accounting. The clean surplus accounting idea is that the ending book value, T plus 1, is equal to beginning book value plus earnings minus dividend. And this is the way how we calculate the shareholders' equity over time. You probably can recall the statement of shareholders' equity. Okay, this is actually the definition of the statement of shareholders' equity. Okay, so for this period 2, what is the beginning value for immediate period? We should see 20, right? And how much earnings we reported in the current period? In this period. I remember we are calculating the beginning value of equity here, because this beginning value, this is the beginning value for this period. Okay, or this period. So 20, we are taking the 20. We are taking the 20 book value, and we are adding what? The earnings of 2.5, and we are subtracting dividend of what? 1. So what is the beginning value of equity we are getting? 21.5. And this 21.5 is the equity value in which time? This time, 21.5. Now think of this 21.5 is the beginning value of equity for this period, year 2. So for year 2, it is now possible to calculate the cost equity charge. How it is possible to calculate the equity charge? We take the 21.5 and we should multiply it by cost of equity. Cost of equity is how much? 10%. So 10% means 2.15. Now, if I subtract the 2.15 from the earnings value, $3, we should get the residual income for the period 2. How much? 0.85. Okay. So have we got this simple calculation? So try to absorb it. I'm taking break for 2 minutes. and I'm returning it by 2 minutes. So try to get this calculation. Okay, I hope you have got this calculation. So is it possible to calculate the beginning value of equity for next period? So can anyone tell me what should be the book value of equity for the next period? I mean, for calculating the residual income for period 3, we should get the calculation of equity from this period. Okay. So I hope you will get this convenient. So let's proceed. So this are the calculation we did in the previous slide. So how the valuation using the residual income look like? So probably this second portion seems very familiar to you. So it looks very familiar to you, right? Summation of cash flows and discounted at present value. But this portion is kind of little bit new. So what is this? This is the beginning value of equity. So residual income is different from other valuation techniques in a sense that it starts with again always the beginning value of equity. It starts with always the beginning value of equity. Then it does what? It includes the present value of the stream of residual income. You see the stream. Okay, present value of residual income. And it is discounted by what? It is discounted by cost of equity. The second definition, what you see is nothing new, just the breakdown of the residual income with which you already have made us comfortable with this calculation, right? So this is actually the definition of the residual income, the detailed way of showing the calculation. So can we conclude that if a firm continues to produce return on equity which is greater than the equity charge, which is reflected here, equity charge. I mean, the equity value, beginning equity value. If a firm continues to produce this level of positive residual income, what do you expect for that firm? That firm will have higher value. That firm will have higher value of their, I mean, this firm will get higher valuation relative to their book value. I mean, if it happens true, every time some positive will be added with what? Some positive value will be added with the beginning value of equity. And if it happens, in that case, what you should see, the valuation is greater than the accounting value of equity. Is it convincing? But if the opposite happens, when the firm's return on equity is less than the equity charge, what will happen? This term will become a negative value, or this term will become a positive value, or this term will have nothing. Are you there? I'm waiting for your responses. So what is your understanding from here? I want to listen from you at this point because we are going forward to little bit advanced kind of application from this part. If we have the confusion here, we'll not get the later part. So hoping that you have got it. You have no queries here. So let's proceed. So think of a scenario. A firm has a beginning value of equity at a time 0, 20. And the firm's residual income in year 1.5, residual income in year 2.85, required return on equity 10%. And we additionally assume the residual income in year 3 is $1 and the firm ceases its operations in 3 years. Okay. So in that case, how can we value that firm? So we should start with what? We should start with beginning value of equity, that is 20, right? 20. Then we should discount the expected residual income for the next 3 years because the firm will cease operations in 3 years. So 0.5 will be here, 0.85 will be here, $1 will be here. Okay. Now, if we divide this number, we should divide this number by what? Cost of equity. 1 plus 0.1, 1 plus 0.1 square, 1 plus 0.1 to the power cube. Now tell me what will be the value here? Do the calculation and tell me what should be the value here. Simon, Ocean, are you there?
Oh, yes, sir, I'm here.
Yeah. Can you please tell me how much you should get here?
Sir, I got 22.29.
22.29.
80.
Okay. So you should get this 21.91. Did I write the same thing here? Okay. So, yeah, okay. Now you see that this valuation 21.91, is it greater than this big 20? So how it is possible to get a bigger value than the current book value of equity? So it is possible because the firm is reporting positive residual earnings, and the firm is reporting positive residual earnings for what reason? Because the firm's return on equity is greater than what? The cost of equity. Okay. As long as it happens, you should get a valuation should be greater than the book value of the equity. Now, let me summarize what have we seen in the previous discussion. As long as the firm has the return on equity greater than the cost of equity, the firm will have the positive residual income. And if it happens, the firm's valuation will be greater than the book value of the equity. Okay. And the opposite is true. Okay. Now, you might wonder, how can this definition be written? Okay, so let me show you the derivation. So residual income, what we mentioned, the equity earnings minus equity charge. Equity charge we measured in this way. Beginning book value of equity multiplied by the cost of equity. So can we consider the earnings or earnings per share can be written in this way? The return on equity multiplied by book value of equity multiplied by book value of equity, and here we have equity charge. Now if we take the return on equity minus the cost of equity here and take the equity value, I mean the beginning book value of equity here, we should get the same definition. Okay, just the derivation, nothing new. Now it is possible to get the residual income, use the residual income valuation to calculate the justified price to book value multiple. So I want this portion, this derivation, I mean to keep it a pause until we do the calculation of market-based valuation in the next class. So I will get back to this later. So I'll not, it might not be understandable to you, but let me show you a little bit that you already think of this one. Think of this one. If we consider the firm will have constant growth model of residual income, constant growth. In that case, this portion will become what? Cost of equity minus growth rate. Are you getting this? This portion, the denominator will become what? The cost of equity minus the growth rate. Okay, when the firm will have constant growth model for residual earnings. Now, what we like to see here, we already have seen this portion, right? We already have seen this portion as a breakdown for what? The residual income. So what can we do? We can write the same thing here. You see here. These are the same thing. So this is just assuming that if the firm has constant growth model for residual earnings. Now, if we assume that the market price of the stock will be equal to the market price of the stock will be equal to the valuation of the stock. The market is efficient. The price of the stock will be equal to what? The value of the stock. In that case, we can replace this equation by saying what? By saying it is equal to the price. Okay. Now, if we divide the entire equation by the book value of equity, we should get what? The same thing. You see that if we divide the book value of equity by this, we should get what? This one. Okay. And if we divide this number by book value of equity, we should get what? This portion here. And here we are getting what? The price over book value. So this is used as a justified price to book value ratio. This is used for what? Justified price to book value ratio. So you have to memorize this to calculate what? Justified price to book value ratio. You'll see this in the market-based valuation topic. Okay. So justified price to book value ratio can be calculated using the constant growth residual income model. Okay. So let's think of a single stage residual income model. You see the book value of equity per share, $30. And the return on equity, 18%, required return on equity, 12%, residual income growth rate, 8%. Now, is it possible to apply this equation? This one? If we assume here a constant growth model. So we should start with what? We should start with $30. We should start with $30 here. And what is our return on equity number? 18%. And what is our cost of equity value? 12%. And here in the denominator, we have the cost of equity minus the growth rate 8%. We should multiply it by what? The beginning value of equity, and that is the 30. And we should get 75. Now, this 75 is greater than this book value of equity 30. How it is possible? It is possible because the firm is reporting, the firm is expected to have positive residual earnings, and that will increase the value of the firm. Okay. And it also assumes that you probably recall the constant dividend growth model, where it assumes that this difference is constant. I mean, over the entire remaining period, the difference between the cost of equity and the growth rate will remain constant. Okay. Now the question is this assumption very, appropriate or very realistic? What do you think? We assume that the difference between this remain constant. We assume the growth rate remain constant. You probably learned that there are constants with this assumption. This is not a very likely realistic scenario. So when a firm has this greater return on equity over its cost of equity, the firm is in a very profitable scenario. So when a firm is in a very profitable scenario, it will attract the competitors to participate here and to make profit out of it. So if it happens, what should you expect? The growth should come down or growth should go up? Growth should go down. Okay. Now, is it possible that if I provide you all the numbers except the G, you should get the calculation for G. Now, if you compare this scenario with the previous scenario, in which case the value of the stock is higher, this scenario or the next scenario, 75 or 80? Here the value of a stock is higher. So ideally speaking, this higher value is coming from higher growth rate. And this lower value, 75, is coming from lower growth rate. Here we get the growth rate of 8%, but in the next we get the growth rate of 8.4%. This is a very simple estimation. Now let's think of the advanced part, which is more testable for your exam. Okay. So you probably can recall the two-stage dividend growth model, three-stage dividend growth model. For simplicity, we assume the two-stage dividend growth model. So or two-stage model. So for the first stage or the initial stage, the growth rate is considered as short-term growth rate. But for later stage, we consider the growth rate will be long-term growth rate. So when it is a short-term growth rate, you will get the scenario that for, say, for example, the short term will be for 3 years. So how can we compute the residual income for first 3 years? So that estimation is straightforward, like the estimation we did earlier in the examples. But for long-term horizon, we need to be little bit, it is a little bit challenging because we need to assume something. So the idea is that in long term, the calculation of residual income will remain constant as the, say for example, we have the short-term period for 3 years. So the question is, what should happen from year 4? Say starting from year 4, and it is the closing of year 3. What should happen to the residual income from year 4? So one very straightforward scenario is that residual income will remain constant forever. Okay. Another scenario is a kind of residual income will become 0 here in the year 4. Okay. Another scenario is that residual income will decline from after this initial stage and will decline to 0. Where if the residual income becomes 0, ideally speaking, the return on equity should be equal to the cost of equity. Okay. So this kind of scenario might happen. So if the residual income remain constant, we consider the persistent factor, which is denoted by omega. You see a symbol look like W. This is omega. So if residual income remains constant, I will show you how to apply the omega later. The omega value becomes 1. Okay. If the residual income declines to, if the residual income remains constant, omega value remains 1. And if the residual income becomes 0 after the initial estimation period, omega value becomes 0. But if it happens that after the initial stage, residual income will be there, but there is a tendency that it will come down. In that case, the omega value will be between 0 and 1. Between 0 and 1. So let me think of some scenarios when there is this persistent factor will be a higher number or will be a lower number. So we consider this discussion as high persistence and low persistence. Now you see that if a company has a low dividend payout, the firms will have a higher residual income or lower residual income. What do you think?
Higher residual income.
Higher residual income, because the book value will constantly remain higher because the dividend reduces the book value of the equity. And the book value of equity has implication for calculating what? The residual income. And if your company has a high return on equity historically, you should have high residual income. And in that case, there is a high persistence. If there is a high persistence, what should be the value of the omega? The omega value will be close to 1 or 1. Or if it remains constant, it will be 1. But the omega value will be closer to 1. Closer to which one? 1. And the opposite scenario is that if the firm has this kind of characteristics, so if a firm has a very high profitability, very extreme level of return on equity, very good level, very high level, very best level, in that case, it will attract the competitors. And when it attracts the competitors, and competitor will enter the industry, and they will kill your profitability and they will reduce your return on equity. In that case, the residual income's persistence will become lower or higher, or will remain same. It will become lower, and its tendency will be closer to what? The 0. Okay. So let's look at an example. How can we apply this persistent factor in the valuation of residual income? Look at this. Don't get frightened by looking at very bigger definition of this valuation. Think it very simple. There is no changes in the numerator. Ideally speaking, this is the residual income. Okay. And in the denominator part, remember why there are two parts. There are two parts. This is the initial stage, and this is the later stage. This is the short-term stage, and this is the long-term stage. Whatever, we are starting with what? The beginning value of equity. And for persistent factor, we are adding another discounting factor here. You see the application of omega here. Got the idea? Other than this, these are very look like this portion, very look like the multi-stage dividend growth model. Other than this part and this part. Okay. So as I mentioned to you, as long as the residual income will remain constant, omega value will be equal to 1. If it goes to 0 after the, after the initial forecast, there is a tendency that it will become 0. It will go forward to 0. In that case, the value will be between 0 to 1. And if it becomes 0 immediately after the initial forecast, this period, after this, omega value will become a straightforward 0. Okay. So let me show you an application so that we can feel comfortable with this. Beginning value of equity at the time 0 is $20. Residual income year 1, 0.5, year 2, 0.85, in year 3, 1. So these are the short term. We don't have the information at this point what should happen in the long run. Required return on equity is 10%, value is 21.91. So how it is calculated? Okay. So if it is the scenario, the firm ceases its operation within 3 years, in that case, you should get the value 21.91. Remember, this is the same thing here we did earlier. This one. Okay. Now here we assumed what? You probably can recall the firm ceases operations in 3 years. But we are now assuming that the firm will continue its operations after year 3. The firm will continue its operation after year 3. In that case, we should assume for what? The long-term forecast. And the long-term forecast, we mentioned what? Long-term forecast, we mentioned that it is likely to happen that the residual income will remain constant at this level, 1, or it will start at 1, but gradually it falls to 0, or immediately after this initial forecast in year 4, the residual income becomes 0. We provided you in which case the omega factor will be the value, which one, okay? And omega value will be given to your question. If it is not mentioned that the omega residual income will remain constant in the long term. If it happens, in that case, the omega value will be 1, or the residual income will immediately become 0 after the initial stage. In that case, omega value will become 0. But other than these two scenarios, the omega value will be given to you. So does this calculation looks very straightforward to you? You see, when you consider the firm ceases its operations within 3 years, omega value ultimately becomes 0 because there will be no residual income. So this calculation is exactly the calculation we did earlier. Okay, look at this slide. Okay, so ideally speaking, there is no complicacy here. But can you tell me, if we assume that the residual income from year 4 will remain constant at $1. What should we assume for omega value? Can you respond? Abdullah Said, are you there? Said? Nafis Jaki?
Yes, sir.
So what do you expect for omega value? If the firm has the same level of residual income from year 4?
1, sir.
1, right? So let's
Yes,
assume
sir.
that scenario. Now, what do you expect if the omega factor is 1 and if the firm's residual income is expected to remain constant at this 1 level? Will the firm's valuation remain same as this, or will be less than this, or will be greater than this?
Same.
Compared to this scenario, in this scenario, there is no residual income after year 3. But in the next scenario, what we are asking from you, residual income becomes equal to 1 and like this, and it will remain at this level forever.
Or it will not be the same. It will be higher, sir.
It will be higher. Do you see this thing here as expected?
Yes, sir.
Okay.
Yes,
Now,
sir.
if we consider that the residual income will slowly moves down to 0, but it will start with 1, which is the last period for our initial stage. We see what? In that case, omega factor will be 1, 0, or below 0 and 1.
It will be between 1 and 0, sir.
Between 1 and 0. In that case, if we consider the 0.6, we are getting the value for what? 22.81. This is in between the two estimate of the valuation. Very expected.
Yes, sir. Yes, sir. 21 and 29. It is between 21 and 29.
Right. Okay. So in this way, we consider the multi-stage model for residual income. So the final part of our discussion is that the later part, I mean, if we assume that the firm will close its operations after year 3, at which price the stock is expected to be traded. So if we have this kind of scenario, 27.5, we can consider this in our calculation. So this is a kind of application of, I mean, market-based valuation. So at the end of year 3, we have the book value of equity 25, and we have average price to book value multiple or projected price to book value multiple 1.1. In that case, we can expect that our stock will be traded at 27.5, the product of these two at this price. So you see that this 27.5 is expected market price. Okay. Now here the book value is 25. Okay, book value is 25. So the difference is the value we expect to receive at the end of year 3. And this looks like very similar to, you probably are familiar with this kind of calculation, that instead of expecting a very terminal growth rate, we can also consider a terminal value. We consider a terminal value. Here our terminal value is, terminal stock price is 27.5. But actually the terminal value is coming from here, the difference between the expected stock price minus the book value of equity, and this is the terminal value, and we can discount this and we get this value. Okay. So let me conclude by saying that how it is different from the dividend discount valuation and the free cash flow valuation. So for this part, these are same. Discount rate is same, required return on equity. But the difference is that we start in the residual income valuation with book value. There is no presence of the book value of equity here. We simply discount the present value of all equity cash flows. And now, if you look at the construction, let me, ideally speaking, if the things remain same and we follow our firm has clean surplus accounting. Can you recall what you mentioned clean surplus accounting? The ending equity value will be equal to what? The beginning equity value plus net income minus dividend. This is the clean surplus relation. But sometimes what happens, you probably can recall we have a statement of other comprehensive income. So the items in the statement of other comprehensive income affects the equity value, but does it affect the net income? Can you recall the foreign currency translation gain, realized or unrealized gain from available for sale securities? Can you recall these items?
Sir, it's outside the scope of net income.
Right. So for these issues, what we just have mentioned, and if it happens for the firm, in that case, the accounting is known as the dirty surplus accounting. This is known as dirty surplus accounting, where the equity is likely to get affected for some items which have not affected what? The net income. Okay, this relationship is not maintained. So if this relation is not maintained, in that case, the residual income valuation and the dividend discount valuation model will give you different values. But if there is a clean surplus accounting, residual income valuation will give you the exactly same value what you get from the dividend discount model. Okay. So you should keep these points in your mind, and you see some kind of application here. And if you can recall again, residual income valuation gives a very large weight on the book value of equity. You can verify it. Out of 23.79 value, 20 value is coming from where? The beginning value of equity. But if you can recall the dividend discount model, most of the values come from the present value of cash flows from initial stage, or most of the values come from terminal value. Can you recall? Most of the values come from where? In the dividend discount model or the free cash flow model, you have a terminal value calculation, right? So most of the weight, most of the value come from terminal value or the initial present value of cash flow estimation?
Terminal value, sir?
Terminal value, exactly. So this is how these two models are different. Okay. So residual income model puts less weight on terminal value, unlike the dividend discount model and free cash flow to equity or farm model. And residual income model is dependent on what? The accounting data. You probably can appreciate the usefulness of accounting data and the problems with accounting data. And this is more useful for non-dividend paying stocks. So we started with this point. And without free cash flows farm, this is more appropriate. And sometimes if you see the cash flows are very unpredictable kind of startup farms, in that case, residual income model can be a good approach. It is based on the economic value. The weakness is that, as I mentioned, the accounting data might be flawed and require adjustment to accounting data. You probably can recall I mentioned that if there is a capital expenditure, I mean, the goodwill is the goodwill is capitalized or research and development is capitalized. This record adjustment for residual income. The research and development expenses cannot be capitalized. This should be expensed. It assumes the cost of debt is equal to interest expense. This is a very strong weakness. Cost of debt cannot be equal to the interest expense always. Okay, but we assume this. So we need to verify that when it is most appropriate, we already have mentioned it, and when it is least appropriate. So we already have mentioned the clean surplus accounting. So this looks like this. So these are some examples of the accounting adjustment needed for applying the residual income model. And this is all about the residual income valuation. So I want you to think of the residual income valuation and try to apply it for your company on which you are making the forecast, and we'll do the valuation later. So that is all about for today's class.